I would like to take Olivier's view on the how monetary policy can potentially incorporate inequality considerations. As we all know, maybe inequality is an issue that falls more at the intersection of different policies, and Olivier and Dani Rodrik look at this in their paper on inequality last year as a result of another Peterson conference. It may be a better addressed through a coordinated policy effort. And in the current context, we see lots of central banks getting into the business of financing governments in response to support their response to COVID-19 pandemic. So I would like to get Olivier's view on some of the policy interactions between fiscal monetary or monetary financial that need to be taken into consideration when we are thinking about how central banks can take into inequality into consideration, and what could be some risks, what are some trade-offs in doing that? Olivier?
Good. Very happy to be there. Let me share a few slides. And the first thing to say is that you get two kinds of invitations to speak on a Zoom. The first one is about things that you know extremely well, and then it's very easy, or about things that you don't know very well, and then it's harder, but it forces you to think about something you should have thought about. This one is very much in the second category, and the risk is the obvious one, which it implies maybe rediscovering the wheel, but maybe also sometimes, fresh thoughts can be useful. I'm not sure that I'm going to succeed, but let me just try. I have 3 slides. I took my mandate seriously. The first point is that we used to have a view, which I shared, that that basically we didn't have to worry about inequality when we did monetary policy. There was monetary policy, it had one instrument, which was the policy rate. You moved it up and down, and the notion that you could do many things with it beyond just affecting inflation or activity was taken as a non-starter. And then anything which had to do with distribution, well, that was clearly fiscal, because fiscal policy is a much more complex beast with extremely many instruments. So presumably you could take care of distribution effects that way. And I think that was the dominant view, at least was my view for a long time. Yes, separate the two. And if I had gotten your invitation maybe 10 years ago, I would have said no, thank you. But I'm nice. I took your invitation and thought about it, and I think you indeed are right that there are interactions. And the point is that I think by its very nature, monetary policy has distribution effects, because the way it works, even getting away from QE, getting away from COVID, the old days when we use the policy rate up and down, basically what monetary policy does is move the most important relative price in the economy, which is the interest rate or the interest rates, right? And that obviously is going to have major distribution effects between borrowers and lenders, between asset holders and not. And Marcus talked about it. And so the very notion that monetary policy works through policy rate implies that it will have distribution effects. Does QE make a difference? Yes, it does, because you get QE, you get many instruments, and basically you move from a policy which moves the policy rate only to policies which decrease various spreads on sovereign bonds, on corporate bonds, and so on. So by the very nature of this additional set of interventions, you're going to have distribution effects. If you help the corporate sector, who are you helping? And therefore, which workers will benefit more, and so on and so on. So it seems to me that the issue was there even before QE and before unconventional policy, but it's there in stronger form now. So the standard answer that Marcus gave, but with the caveats, is the answer we would give when we were asked, but yeah, sure, I mean, there are distribution effects, but through a decrease in unemployment, if you have an expansionary monetary policy, you're doing more than whatever else you're doing on the distribution side. So even if some workers are affected, you don't have to worry too much, because what you're doing is helping everybody. I think that is what we should reconsider. It's not completely obvious. There are 2 effects. Maybe one indeed dominates, maybe the other doesn't. And so what I do in the 2 remaining slides is actually discuss three issues which come up in that context. So the first one is, should central banks distribution effects into account? And I think that my answer is a bit different from Adam. I think that the mandate of many central banks is yes, and basically down the mandate of the bank Adam knows very well, the Bank of England, and it's strong, sustainable, and balanced growth. And you can interpret this as saying distribution matters. I don't know what balance means, but presumably it means something like this. And so it seems to me that it is in the mandate of the central banks to think about the trade-off between what they do to activity, which is the usual way of thinking, and what they do to distribution. And it seems to me that the answer can go either way. So I took two examples. The first one is, suppose that there are only distribution effects. So you decrease the rate, it increases the stock market values, but it doesn't have any effect on investment and not much effect on consumption, because maybe uncertainty is preventing consumers from increasing consumption. Well, in this case, all you get is this distribution effects, not an effect on activity. This is, we can think of this as a vertical IS curve, in which case that shouldn't be the job of the central bank. It should be done through fiscal policy. Basically, there is just no point in having the central bank do it. All it's doing is basically worsening the distribution. So it seems to me in this case, if you care about this, then the fiscal authority should send checks to people, finance it by debt, and that's the end of that. Another example is, and that's more relevant now, when there was only one instrument, well, you used it or you didn't, but now you have many instruments, and there's a choice. You want to increase activity, and you have a choice between negative rates or decreases in spreads. So you can either just set the rate, the policy rate negative, not too much, or you can buy corporate bonds or sovereign bonds. Then it seems to me that that's a choice which might have the same effect on activity, properly calibrated, but will have very different distribution effects. And implications for the various players are quite different. So in particular, this is not the case for the moment, but if the negative are passed on to depositors, then this will have a direct adverse distribution effect on them. So in this case, it seems to me that the central bank should think about distribution effects and choose one measure rather than the other. There are many other considerations, but this should be in the basket of considerations that the central bank should think about. Last issue, a third example, where it's less evident what the central bank should do, is now suppose that you're into spread reduction. So you can reduce the spread on both those bonds or sovereign bonds or whatever. Then it seems to me that there it becomes much more iffy, because then the political aspects become absolutely first order. It's very easy to see who is helped and who is not. So that I would be more reluctant to take into account if I'm a central bank, because again, it's getting to politics in a way which is too close. I think the other two examples are fairly clear. Let me end with that slide, which is, well, suppose that it has distribution effects and suppose that they are adverse. So you think there's too much inflation, not exactly the case today, and you want to tighten. Well, you're going to basically make a number of people worse off. Borrowers are going to face higher interest rates. Well, maybe you can combine money and fiscal in order to get the effects that you want, but protecting the borrowers through lump sum transfers. Conceptually, that works. Now, the practice is that fiscal policy doesn't move very fast. We see this in the US at this point. So the notion that you can kind of coordinate at high frequency is not terribly convincing. Conceptually, I think it works, but in practice, it's not obvious. However, we're in a different place today. We don't have cyclical effects. We have secular stagnation. And basically, we have low aggregate demand, and it's going to last fairly long. It has lasted long. It will last fairly long. In which case, it seems to me that that's a case in which, even if fiscal policy takes time, maybe you can combine the two. So I think that should be explored more. When there are adverse distribution effects and they can be corrected by fiscal, yes, there is room for both. And then the last point is, should central banks further extend their set of instruments? So at this stage, have policy rates and decrease spreads. And when how central banks affect the economy. They affect the economy through asset prices or interest rates, not by buying or selling goods. And there's a sense in which it would work much easier. If you want to help activity, you just buy goods, and if you want to slow it down, you sell goods. Okay, so it's tempting. And the issue is, well, there are many issues. One of them is technical, right? Which is it's very easy to buy goods. It's much harder to sell them. It's not clear what it means. So it's easy to give helicopter money, to just drop it. How you get it back if you want to kind of contract is a bit harder. Helicopters are not very good at that. So it seems to me that's probably a non-starter in most cases. And then there's a very nice paper by Patrick Onahan for the Peterson Institute on monetary policy and inequality. And he says that politically, that basically is outside of the realm of things that can be done. What's known as the Overton window, which is the space that you have politically to do things. So I think it's probably a non-starter. If you actually want to increase demand through, whichever way, then do it for fiscal, except in one very specific case, which seems to me to be relevant today, is if you intended to help the people, say by dropping dollars from helicopters, and you intended to finance it through the inflation tax, then yes, I mean, basically this is what helicopters. It seems to me that's a very weak argument in practice. And even if you wanted to do this, it seems better to basically send checks to people, finance it by debt. And if you decide that the way you're going to basically eliminate the debt or reduce the debt is through inflation, then the central bank can come later, buy the debt and monetize it and inflate it away. So I see absolutely no point in basically looking at buying goods or helicopter money under any circumstance that I can think of. Good.
Thanks, Olivier. Thank you. So if I understand you correctly, you think that it should be instrumentalized by fiscal policy rather than monetary policy, and monetary policy can come in at a later stage. So because it's more effective doing through
95% of
95%
distribution issues should be done by fiscal. I think that I took this as a given. That's not the job of the central bank. I was thinking about what the central banks do and the implications and whether they can help.
Thanks, Olivier. Thank you.